Hi, Anthony.
Okay, hi Jeb. All right, so
Cool.
let me just share the screen and then we can look at it. So you said you did 20 questions from this one.
Yeah, so I did 18 actually.
18, okay.
Yeah, so I did the first 18 in the multiple choice.
All right, so yeah, this is the paper. FIN3701, it's the, oh, sorry, I opened the wrong one. This is October, November, May, June, wrong paper. Let's open the other one. October, November, May, June, here's it. Okay, there's the right one. Okay, so this is the paper, May, June 2016, Financial Management. We're looking at the multiple choice first of all. Okay, so when looking at the May, June paper, obviously we need to do workings for some of these multiple choice questions. Some require working, some don't. Some are just theory.
Yeah.
The first few I think were theory. Let's check.
Well, Anthony, so I'm pretty happy with the first 18. You know, and I know that I do have the answers to the stuff anyway. So I mean, I'd like us to go through this just so that we can possibly highlight some of the stuff that I actually need to look at more than anything.
Yeah, I know that you are wanting to focus on the ones that you're struggling with. So I think let's just go through them quickly, and then you can tell me, did you understand this or didn't you? If you didn't understand it, then we can go through it in more depth. If you did understand it, we can just carry on.
Yeah, cool. Okay, so for the first one, I got option 2.
Option 2 here was the one that was false. That was correct. Yes.
Yeah.
So if I'm looking at the statement, obviously, where's my pen? Let me just get the pen.
And I mean, the question, there was also an errata in the question there. I mean, because it says, which of the following statements is correct, incorrect?
Yeah. Which of the following statements is correct, incorrect? Yeah. You can see they've made a mistake there. But if you do the question, which you probably did do, it was true, false.
Yeah.
True. False. True.
Yeah.
All right. So obviously, by a process of elimination, you would probably identify this as being choose the one that's incorrect.
Yeah.
Okay. That would
so the
be
second.
Out. Errata.
Okay. So then the second one, just so that we can go through the ones and just tell me if my thinking is right. Okay. So the second one, I got to option 4 because what you do is you take the net income and then you add the depreciation to it, which gives you your operating cash flow.
Yes, that's correct. Yeah, net income plus operating cash, plus depreciation gives OCF, correct. So this was the 250,000 plus depreciation of 12 gave you the 262, yes.
Yeah, cool.
That's correct.
100%. Okay, the third one, I got 280. And these are my working out costs here. So I've got installed cost of new asset is 310 because it's 300,000 Rand plus the 10,000 Rand for the installation. Okay. So if you look at it's the first two line or the second line that says 300,000 plus. So you want to look at the initial investment, yeah. Okay. So I've got 300,000 plus the 10,000. Then I've got after tax proceeds of minus 100,000. So, the present. Yeah, well, you would minus 100,000 from the 310. Your changing working capital would be 110 minus 40,000.
Yeah, so that's right. So you've got the right workings here in terms of subtracting the after-tax proceeds of the old.
Yeah, so effectively you taking off 30,000 Rand off the actual thing because your change in net working capital is a positive of 70,000, or it's an outflow of 70,000, not an inflow.
Yeah, it's positive.
Yeah, so it's an additional outflow, not an inflow. So your actual answer, your total initial investment is 280,000.
Yes.
Which is option 3.
Yeah, so that one you managed, that's correct, yeah.
Okay, cool. On number 4, I got option, it's also an installed cost one with a replacement. I got 33,600. So basically what they're asking for there is basically, it's just what the tax benefit, it's basically just working out what the tax benefit would be because there's actually a negative on the sales price.
Yes, because you're trying to calculate what the actual amount is. Yeah.
Yeah. So the book value of the asset is basically 30,000. Your sales price is only 40,000 or 24,000. So you need to work out what the tax benefit is on the sale, which would be 2,400 rand. So it brings your actual spending, your initial capital outlay becomes 33,600, which is option 3.
Okay, no, that one was wrong.
Wrong.
You forgot the scrapping allowance.
Okay.
Okay, so number 4 we need to look at in detail.
Okay,
because obviously you're looking at the install cost. So you had the right formula in terms of thinking.
Yeah.
So the installed cost.
Yeah. Was 60,000.
Yeah, 60,000. That's fine. That's the easy bit.
Yeah.
Okay. Then you're obviously lessing the after-tax proceeds of the
sale.
Yes. Okay. And then with the after-tax proceeds of the sale, there was a loss on the sale. Do you agree?
Yes, because it was 24, but the book value was 36.
Yeah. So there's a scrapping allowance. Okay. So let's double check the working. Okay,
yeah.
So if I take 24,000.
So that gives you 6,000. So what I got was 6,000 times by 40%, which is 2,400 rand.
Let's see. Let's just double check. Where is the? Let's see here. Okay, market value is 24. That's fine, and the book value was 30. So 30 minus 24 is a 6,000 rand loss.
Yeah. So and then
so
you times
6,000 times what is the tax rate here? 40%.
Yeah.
Gives you 2,400.
I'm actually pretty sure I'm right with this.
Yeah, okay, so that's the benefit.
Exactly
okay, so that's the tax benefit, which is the scrapping allowance.
Yeah.
That would have added
to your
to
24,000. So it actually becomes 26,400.
Yes.
So
and then
33,600, which is option 3.
600, yeah, that's fine. Okay, yeah, sorry, that's correct.
Yeah. I got that. I'm pretty good with this. This stuff I'm pretty good with.
Yeah, that's fine.
Okay.
Because then that gives you the 26,400, and then the difference would be the 33,600. Yes, that's fine.
100%. Okay. Then on question 5, so I've actually got the workings out that I've done here. So this is your payback period, which is quite easy. So I mean, if you look at it, the first 3 years you get 270. You need to pay back 280. So, and then the 4th year, if you divide 4 by 12, gives you 10,000 rand per month. So it's 3 years, 1 month. So it's option 1.
Yeah, 3 years, 1 month is correct because you're just looking at when do you cover the initial investment. Yeah,
100%. Very, very easy. Okay. The next one in capital budget risk refers to option 1, the degree of variability of the cash inflows.
Yeah, that's theory.
Yeah. Okay. Okay, so then for the next one was also quite easy because I think it was, you basically used the calculator, and what you did was you took your 150,000 was your future value, your present value. Your I would equals the 10 plus 3% because the risk premium gets added to what the risk-free rate is. You'd have your cash flows. Sorry, it would be a cash flows. So you'd use your cash flow. So your first cash flow would be negative 150,000. Okay. So your first cash flow would be negative 150,000. Then you've got 4 equal cash flows of 50,000 in successive years. Yeah. Okay, so those would be positive cash flows, and you basically do it on the calculator, and it gives you negative 1276.433723.
Correct.
Yeah. So I'm pretty happy with that one. Okay, the next one was replacement of the old machine. So what the installed cost was 35,000 rand because you've got 30,000 rand plus 5,000 rand for your installation. Okay, then you've got the book value was, your accumulated depreciation is 20,000 rand. So you would minus your accumulated depreciation. Your book value of the machine The old machine is 15,000 Rand. So your initial purchase price was 35,000 Rand. You had an accumulated depreciation of 20,000 Rand, leaves you with a book value of 15. You sold the old machine for 10,000 Rand, which minus the book value gives you a negative 5,000. So you would have a tax benefit of 1450, which is option 3. Also pretty much very similar to the questions that they've had before. Like I think there's like 2 or 3 questions where they have pretty much a very similar sort of trend in it.
Yeah, so obviously if you're selling an asset at less than what its book value is, you're obviously going to incur a scrapping allowance or a recoupment. So obviously 5,000 is the difference between what you're selling it for and what the carrying value is.
100%. So I mean, there's a couple, I think 2 or 3 questions before that in some of the stuff. There's a scrapping allowance on pretty much every single one of them. I think it was question 4. Question 4, there was one definite. Question 4. So there's been 2 questions where they asked pretty much something around the scrapping allowance. So I was pretty happy with that. Okay. So the next one would be your weighted average cost of capital. So what I did was you take your capital of long-term debt. So you take your capital, which is 40%, times by the 10%. And that would be times by 1 minus 0.35 because you need to take the tax into account on that. Okay. Then obviously the rest of it, it's 10 times 11 and 50 by 15. Eventually you get to, the answer I got to was 11.26 or 11.2%, which is option 3. So I'm quite happy. I'm quite happy with how that works. I had to do it a couple of times I wasn't 100% sure about the tax. Once I got the tax thing right, I sort of got the calculation right on it.
Yeah, well, the WACC is quite simple because it's just weightings times costs. Just remember that with debt, the tax is interest is tax deductible. That's why you take off the tax rate from the actual costs.
Yeah, that's why I just wasn't sure exactly. I just wasn't sure about the 1 minus 0.35, so I had to go into a little bit of just digging in the textbook and stuff to find that out.
And then you add all those amounts together and you get the WACC.
Yeah. So I'm quite comfortable with that, with the theory around that. The next one was around issues of new preference shares. So you use the P equals DIV 1 over R, which would, your cost equals 10% of 100. So it's basically 10. So your dividend is 10 over 100 minus 2. So it's 10 over 98, which gives you 10.2%.
Exactly.
So option 4. Okay, quite happy with that. The next one you had to do a double thing. So you had to do the normal cap M as well as the Gordon growth, because you had to work out the cap M in order to get part of the Gordon growth stuff going. So your first formula would be exactly the same as the issue of the new preference, but minus the growth. So divided by R minus G, okay? So you've got everything except for the R. You can basically put everything except for the R. So you've got 34 cents, and you've got 10% is your growth. Your cap M, you basically use your risk-free rate plus the beta times by the market rate minus the risk-free rate, and that basically comes out to 19%. Okay. And then if you funnel that back into everything else, you come up to, so then you substitute the R with 19 where we had it there in the G. You get to 0.34 divided by 9%, which gives you 3.77, or rounded up to 3.8, which is option 2.
Yeah, that's right.
Yeah. Okay. So I'm quite okay. The next one we actually did a question like this earlier, which was the breaking points. So basically, it was quite easy. I mean, you just basically take your breaking points of equity, which is 300,000. You divide that by the 60, which is the weighting of it. So your finance equity is 60%, and the 300,000, and then you take the debt of 40%, and you divide that by the 150,000 by the 40%, you get to the 500,000 and 375, which is option 3. And that's, I mean, there's not, okay, so there was a question that I wanted to ask there, is just why, what about all the information about the additional and the ordinary shares and stuff like that? Is that just there to basically fool you?
Well, they're talking about a scenario where the firm has exhausted the retained earnings. So if they exhaust the retained earnings, then how are they going to raise additional capital? They're going to need to issue new shares. Okay, but is there a limit to the amount of shares that you can issue? Not in this scenario.
Yeah. Okay, but so then what does the breakpoint actually mean?
The breakpoint means that if I'm raising finance through equity, okay, 500,000 is the total amount of finance that I'm going to need. So how much does this project require? We don't know. Okay, if the project requires, let's say, 600,000.
Yeah.
Okay, are you going to have enough retained earnings?
No.
No, you won't. Because 600,000 times 60% is what? 330,000. 360,000.
Yeah.
Okay, 360,000 exceeds the 300,000 retained earnings.
Okay.
Okay, so the break point is basically a limit in terms of your total funding, which will then require other sources of capital. Okay, so it would basically be the total amount of funding that you could get out of either like increases, so either selling new equity or new ordinary shares, or going and financing extra debt. That would basically give you your top out. Well, yeah, it's the limit, it's the maximum. So, for example, here, in terms of equity, the current equity in terms of retained earnings currently has 300,000 in the business, meaning that the 300,000 could fund a project of 500,000. Okay, cool. And if you wanted to, how could it fund a project of 500,000 though? Because let's say you wanted 500,000. Okay. If you want 500,000, let's go and draw this here. Yeah. Because this was one of the things I just wanted to wrap my head around. Like, I understand the formulas and stuff, but I'm not understanding what you're actually doing and why there's all this other additional information in there. Okay. So total finance, how much do you want? 500,000. Okay. How is the company splitting this? Debt and equity. How much equity must the company use? Well, they had less than 40% there. Saffron Finance, 60 equity. It was 60 and 40, yeah. And it was 60 and 40, yeah. Where's my working now? I think it was right. There we go. 60 equity, 40 debt. Right, so can we finance this project? Well, what is 40% of 500,000? 200,000. What is 60% of 500,000? 300,000. Okay, do we have enough retained earnings? Yes, we do. Yes, we do. Okay, that's the maximum. So this is the break point. Okay. Okay, 100%. Right. The breakpoint meaning, if the project was 600,000, if we needed 600, 600 will be split, debt 40, equity 60. 60% of 600,000 is 360,000. Do we have enough equity? No, retained earnings is limited to 300,000. We've broken that. Okay, so that means that we cannot finance a project for 600,000 because we don't have enough retained earnings. There's a limitation placed on the retained earnings. Okay, and there's a limitation placed on the debt. But now, what happened? But your debt can go to 375, though. Yes, that's why the break point for debt is higher. Okay. Okay, meaning that we have a higher maximum limitation placed on the debt. For example, here, 375 is the BEP, the breakpoint on debt, meaning you've got more than sufficient debt to finance larger projects, but you don't have enough equity to finance larger projects.
Okay, cool. No, I understand. Okay, I understand that now. Okay, so the next one I wasn't 100% sure about, but I mean, it is something I need to probably read up a little bit more in the theory. But I thought it would be accept only those projects on the iOS up to the point where the firm's financing is exhausted. So option 3. But I mean, Anthony, I'm not going to ask you to explain this to me because I'll go read about it. I mean, it's just something I just haven't read about, the weighted marginal cost and stuff.
Okay, what do you understand by the weighted marginal cost of capital?
Not much, really.
Okay, so do you not want me to cover it, or should I?
Well, let's do it, yeah. Okay, let's do it.
All right, so if I'm looking at 13 is asking about theory relating to the weighted marginal cost of capital. Right, so that's the diagram that looks like this. Okay, where you've got IRR and you've got the cost of capital, the WACC.
Yeah.
Okay, so obviously if we're looking at projects, and then this is obviously looking at capital.
Yeah.
Right, in terms of investments.
Okay,
so if I'm looking at an investment, do you agree there's going to be projects that require a certain amount of capital?
Yeah.
Right, so if I'm going to be accepting one project, let's say the first project requires 100,000. The next project requires another 100,000. So now we've got 200.
Yeah.
Okay, let's say we keep accepting more projects. The last project needs 1 million. Okay, is cost of capital going to go up or down over time?
Going to go up over time.
Exactly. The cost of raising more capital is going to increase. So if I'm looking at this, the WACC.
Yeah.
Okay, the WACC is going to start out relatively low, and it's going to go up and up and up with more and more projects.
Yeah.
Okay, because you can raise finance, and finance will generally be quite cheap when you're starting out a new project because everybody would be wanting to give you capital.
Yeah.
With more capital comes more risk. You would be able to raise more finance at a later stage, but the costs are going to go up.
Yes. Okay. So your cost, 100%.
Okay.
Because obviously it's shown that the investors, or the return that the people that are either the equity holders or the debt holders are going to want is going to be higher because it's more risky.
Yes. Okay, so if I'm looking at this, the IRR is looking at the iOS. iOS is the investment opportunity schedule. That's what it is there.
Yeah.
Okay, so let me ask you, with the money that you raise, so if you're raising 100,000, are you going to accept the best project or the worst project?
The best project.
Exactly. And the best project is going to have the highest or the lowest IRR?
The highest.
Exactly. So that's going to be here.
Yeah, okay.
That might be 20%.
Yes, so the next project comes down, and it comes down, and it comes down. So what you would do is basically meet up until where the two lines meet each other, or to a place.
All right, so have a look at this. Where will I accept? I will accept on the left, and I would reject on the right.
Right. Okay, no, cool. I understand it now, 100%. Understand it 100%.
Okay. So don't you think it's easier to ask me rather than to go read like 5-10 pages?
Yeah, no, 100%.
Okay. Right, I'm here to make your life easier. So if you have questions about theory, ask.
Yeah, no, cool, 100%. Okay, so we can move on to the next one. I've pretty much got that one. 13, 14. Okay, so... Yeah, okay. We've covered leverage a little bit. I thought these were a little bit, I just thought the stuff was a little bit. So what I thought was, obviously, leverage is a firm results from the use of fixed assets or funds to magnify the return on the firm's owner. So I would have said that A's pretty much sounds correct.
Yes, it is.
The more leverage the firm uses, the lower the risk of insolvency. That sounds incorrect, because the more finance and stuff, the bigger your chance is of having insolvency.
Yeah, leverage means debt.
Yeah, Yeah, 100%. Okay. The operating break-even point is the point where EBIT equals total operating expenses. I would say that is it, yeah?
For this one, no.
No, that's also incorrect. That's also incorrect.
Yeah, because it's operating break-even point.
Because your break would be where your ERBT equals, or where your sales equals cost plus fixed costs.
Well, operating break-even point, yeah. Break-even point is the BEP.
Yeah. Which equals, selling price over variable costs. Yeah. So, I mean, that's based, okay. So I understand that one. Financial leverage uses fixed financing costs to maximize the firm's earnings per share.
Okay. Look at the formula for financial leverage. What does the formula have?
EPS.
EPS, exactly.
Yeah. Okay. So A and D. Look, I didn't get that one, but I mean, I think we've covered that a bit. So I didn't actually get that one. I wasn't 100% sure about that. Okay, number 15. Okay, number 15 was a break-even point, which is what we've just discussed. So it's a BEP, which is FC divided by the price minus the VC. So you would have, in this question, you would have 4,500, which is your fixed cost, with a unit sales price of 12, and a total variable cost which you had to work out, which was 7,000 divided by 1,000 to give you 7 Rand per unit. So it's 12 minus 7, and that gives you 900.
Yeah.
Which is option 3. Okay. The next one, there was a little bit, no, not this next one, but the one after. So number 16 was fine. Okay, so that's the degree of operating leverage, which was, it's just the standard equation. It wasn't the degree of, it wasn't the one of the other ones, which is basically the change in the percentage change in your earnings before interest and tax over the change in sales, or the percentage change in sales, which is 80% divided by 50, gives you your 1.6, which is option 4.
Yes.
Okay. The next one, I mean, I got to 1.385, but it seems like they must have rounded it up. But so you're not actually using the normal, sorry, I just want to just check this because.
Yeah, you're right.
Give me a second. Yeah, I just want to check what the other one is though. So your degree of financial leverage would be the EPS divided by the EBIT, the change in EPS divided by the change. So you use the other one, which is the DFL at base level, EBIT, which is EBIT divided by EBIT minus the interest, minus the price, times by the tax. Well, 1/1 minus the tax rate.
Yeah, that's the right formula for DFL.
Yeah. So I got the right formula there. What I ended up getting to, so it's 200,000 over 200,000 minus 50,000 minus 4,000, which is your dividend. So the P is actually it should just be. I mean, I don't know why they put PO there when they should just put D, a D, to be honest, just to make it easy. Okay, so it's a dividend one. So basically, I come down to it. You get down to 1.3885, and I round it up to 1.4 because that's the only answer that they've got.
Yes, yeah. So there isn't an exact answer, but the closest option is 1.4. So they might have maybe used rounding, perhaps, but there could be errata here. But if you had to be forced to choose an option, you would choose 1.4.
Yeah, and then obviously that affects the next question as well, because obviously now your degree of financial leverage, which is the normal one, so it's the DOL times the DFL. So your 1.6 times by 1.4, which gives you 2.24 if you use the rounded up. So your option 3.
Yes.
Okay, yeah, and that's pretty much where I got to with this today.
That's really good. Your workings are really good.
Yeah. Yeah, I'm getting. I think if we'd have done that, I think if we'd have gone through that other thing last night, I think a lot of this other stuff would have been quite a bit easier as well. I had to go and look through the formulas and and try and get an understanding. But at least I'm picking it up now. So and I'm putting the right stuff there. So
good. It's getting better. Right. So what are we going to do here with 19?
Okay, I'm just checking. So would this not be sure? This before tax? I have no idea.
Okay, what are they asking you to calculate?
What the firm's estimated value is.
Exactly. So firm value is calculated using what equation?
I have no idea.
Okay, it's very similar to Gordon growth.
Okay.
But you're using WACC instead. So net operating profit after tax over the WACC.
Okay, over the WACC. Okay.
Okay, so do they give you the net operating profit after tax?
Yes, they do.
No, they don't.
No, they don't. So you have to work that out first of all. So you would take your EBIT, you take that and you would times that by the 29%.
No, well, yes, but 1 minus because you're taking off tax.
Yeah, okay.
Divide that by the WACC.
Okay. Which is 0.2. Okay, so that's easy enough actually.
Yeah, and you don't get an exact answer. So again, there might be a problem with the actual answer. You get close, but I don't know why they just don't give you the right answer. I mean, have a look at their wording. The wording says the firm's value is estimated to be closest to.
Yeah. So I mean, that's probably okay.
Yeah, you actually get this. You get 7754. I'll write it down. 7754 7265. That's the exact answer. Okay, I don't know where they get these answers from. It says estimated to be closest to. So I mean, I mean, if I was the examiner, I'd just put the right answer. It doesn't make any sense to give estimated to. Yeah. But anyway, it's what it is.
And obviously, if they had to say that, and if they had to say that there was interest, that there was interest paid, and then you'd have to take off the interest before you took off the tax,
of course,
and stuff. Okay, cool. No, 100%. I understand that now.
Okay.
Okay. The next one would be, I would say that between the sales and earnings per share would be total.
Good. Next.
Is that correct or is that not financial?
Correct.
Is that correct, eh?
Yes.
Okay. Cool. Okay, the residual theory of dividends. The firm's equity need exceeds the amount retained earnings. Okay, according to the firm's exceeds the retained, the firm would. I would say pay no cash on dividends.
Definitely, yeah, because if they need the retained earnings, they're not going to pay out any dividends, correct?
Yeah. No, 100%. Okay, the clientele effect refers to I would say 2, the firm's ability to attract shareholders whose dividend preference are similar to the firm's dividend policy.
Correct.
The Gordon bird in a hand argument suggests that shareholders attach less risk to current dividends.
Correct.
Structure 40% debt, 60% the 2016 investment schedule. The firm follows. So if it follows the residual thing on dividends, it would pay no dividends.
No, not in this case. You need to do a working.
Okay.
Residual means I'm going to pay out anything that I don't require to fund projects.
Okay. Anthony, are you still there?
Yeah, I'm still here. I'm waiting for you to...
Okay. Yeah, okay.
To give me the split. So I said we need to look at this split, right? The funding of projects.
So 40%. So 40% is debt.
Yes.
And 60% is equity.
Yes.
Okay. The total investment schedule is 4.2.
Yes.
And the retained is 3 million. So yeah, we would do similar to what we did with the other one. We'd basically calculate the break even or the break point.
No, we don't need the break points here. We need to look at what's residual, what's left over. Okay, so how much are we going to need?
4.2 million.
Yes. How are we funding that?
Okay. We're funding that through 40% debt and 30%. Oh, so we just divide the 4.2 million by the 40% and the 60%, and then and then you minus whatever the equity requirement is from the three. If it's more than 3 million.
Okay, you don't need to work out breakpoints if they don't ask you for breakpoints. So there's breakpoints mean nothing in this question because it's not asking for the limitation placed on the finance that is currently in the business. So with this one, they're telling you that a firm has an optimal capital structure of 60-40. 40 is debt, 60 is equity, and they require 4.2 million. Right, so this 4.2 million is going to be raised through debt and equity. What is 40% of 4.2 million? Well, 1.68. What is 60% of 4.2 million? 2.52. Alright, so how much retained earnings do they have available?
500,000, but 480.
They have 3 million. So do they have more or less than what is required?
They have more than what's required, so they would pay out 480.
Exactly, they'll pay out the difference.
Okay, cool. Okay, I understand what they're asking for.
Residual means what's left over. Right, are there more projects to accept? No. Okay, we've accepted all the projects and we've used 2.52 million rand worth of our retained earnings. What's left over is then paid out in the form of a dividend.
Okay.
Okay, that's the residual theory of dividends. Residual means what's left over.
Yeah, cool.
Okay.
The share split is 2. I would say to affect the firm's capital structure.
No, if you're splitting your shares, so for example, let's say we've got a share that's worth 1,000 rand.
Yeah.
Okay, if you split that one share into 2, how much is each share going to be worth?
500. Okay, so that would be enhance the trading activity by lowering the market price.
Exactly.
Okay, cool. Okay, now I understand that now.
Well done, that's a really good effort.
Yeah, I think by Monday after I've gone through a couple more and just gotten used to just get used to some of the way that they ask the questions, it'll be quite a bit quicker as well.
Yes.
Okay. Okay, so the long question, Nuggets Limited. This is pretty much the same as the question in the 2017 exam. It's just not as long. The question 2, where they're talking about, so I mean, the thing is where they has maintained stable sales and profits, but there's been growth in the market, but they haven't been successful in it due to technical problems with current machine. So they're going to increase the production. The company is considering replacing the current machine with more technologically advanced. Details of the current machine. Okay, so let's, first of all, good exam technique. Let's look at what they're asking. Calculate the initial investment of the machine. Okay. So, okay, so we would look, so they've given us what the cost is of the the current machine. Output, blah, blah, blah. Details of the variable details of the new machine. Okay, so I mean, it's pretty. I think the first question, the first 4 marks are pretty simple. So your initial investment is 30,000. Then you've got your book value or your realizable value and your book value. So they've actually sold this machine for 4,000 Rand more. So they've sold it for 20,000 Rand, which is 4,000 Rand more. So you need to calculate the tax on that. So your tax would be the 4,000 Rand times by the tax rate, which is 29%. Okay, so you're looking at 1160.
Good.
Okay, so that gets added onto the value.
No, not added on, subtracted, because you sold this asset at more than its carrying value.
Yeah, but I mean, it basically gets added to the initial cost because it's a cash outflow. It's not a cash inflow. Whereas the 20,000 is a cash inflow. So your total cash, so you'd minus that off that. So your total cash inflow would be 18,840. And that would give you 11,160 would be your total investment.
Yes.
Okay, that was easy enough. Okay, the second part, calculate the operating cash flows on both machines. Okay, output per annum, 2,600 units. Okay, so this, for me, what it's asking there, the operating, it's got nothing to do with the actual, this has got to do what the cash inflows would be. So it's got nothing to do with the purchasing of the machine. So basically, what you need to do is, on the first machine, on the current machine, is you take your output, which is 2,600 units. It doesn't tell you what. Does it tell you? Okay, so the sales widget is 8 Rand. So your times 2,600 by 8 Rand. And I'll work all of that out now. You've got your fixed, and that would basically be that would basically be your operating output, isn't it?
Yeah, you're looking at sales. So how do you get your sales figure? Price times quantity.
So it's just your cost. Just your cost. So it's got nothing. I mean, it's got nothing to do with your cost. It's just got to do with your sales times by your. It's just got to do with your costs times by your number of units.
Okay. How many calculations are you going to be doing here?
Is the operating cash flow? No, wait. Okay, you need to take depreciation into account, all of that sort of stuff.
Yes.
Okay, so what you would be doing is you would be taking obviously your sales. Okay, you'd be taking your sales units, which on the old machine, and then the new machine. So you'd be doing basically a balance sheet or like an income statement type thing.
Exactly.
And then you'd put what your cost, your sales cost, your sales revenue, your sales per unit, the price per unit actually is what it should be. Then what your total sales would be, less what your cost or your variable cost per unit, and that would give you your GM.
So let's get the sales figure for the new machine. What is it for the 5 years?
Yeah, I'm just putting it all down quickly.
Okay.
Okay, that would give you your GM minus your fixed costs, gives you EBRT. There's nothing mentioned here about any interest, so there wouldn't be interest. So your EBRT would be tax tax amount, and that would give you your NPAT, and then plus your depreciation. Okay, so on the old machine, you've got 2,600 units at 8 Rand. On the new machine, you've got output per annum is 7,000 units at 8 Rand. So your total sales on the one is 2,600 times by 8 equals. So the first one, your sales is 20,800.
No, that's on the second old assets.
Yeah, for the old one. I'm just saying 1 and 2. So on the old asset, the new asset, your sales would be 56,000.
Yeah, so let's focus on one asset. So either look at the new or look at the old. Don't do both at the same time. That's going to get very confusing.
Yeah.
So from an exam technique point of view, like if you look at what I'm doing here, I'm showing you that this is for new, and then show the sales, the fixed cost variables, and all of it for year 1 to 5, and then deal with the old separate. Okay, you can start with the old if you want. It doesn't matter which way you do it, but don't do them together. Do them separately.
Yeah. I'm just doing it like a normal. Like you would do a normal thing where you put the variable costs and all of that stuff in. So I've got all of the information in there. So I'm just using the calculator just to calculate each thing at the same time.
Okay.
Times by 4 equals, so 10,400. So that gives you 10,400 would be your general margin there. 7,000 times by 3.5 equals 100. Okay, your fixed costs are 14,000 on the new one and 6,000 including depreciation. Okay, so you need to also calculate what depreciation is on the old one in order to calculate that back, because it says the fixed cost per annum is including your depreciation on that one.
Yeah, so you have to add back the depreciation at the end, correct?
Yeah.
Because that gives you the OCF.
Okay, so your realized sales profits through 7 years over 5 years. Okay, so that's 7,000 Rand a month or 7,000 Rand a year.
Yes, depreciation for which assets?
For the old asset.
Correct, yeah. So depreciation for the old asset, if we're looking at the old, I think maybe I'm just going to put a line here.
Yeah. The book value, so it's... Okay, so it's only depreciated for 2 years. No, it's more.
How many years?
Well, 5 years.
Well, the useful life of the project is 5 years.
Yeah.
Okay, but how old is the asset?
It doesn't actually say. It says over the profits over the past 7 years.
Yes. Okay. So the old asset.
But the book value. But if the book value of the current machine is at 16,000, it means that it's like 2.5 years or something. Because if you take 3 years times 7,000, it gives you 21,000.
Correct.
Okay. So I mean it's less than 2.5 years.
Yeah. So if you do the working, you actually get it to be 2 years and 5 over 7. Yeah. So it's 2. It's 2 full years and then 5 over 7, basically as a fraction of the year.
2 and 5 over 7.
Yeah, because remember the depreciation is 7,000 per year. So the 19,000, the depreciation is how many years? 2 years and then 5 over 7.
Okay, so you take the 16,000 and you would divide that by the 2.5 over 7.
Why would you want to do that?
Because you want to get what the annual depreciation is.
Well, annual depreciation is 7,000.
Is it 7? So you just add 7,000 back.
Yes, for year 1 and year 2, but then there's remaining depreciation in year 3.
Okay.
So year 1, year 2, and year 3. Okay, so in year 1, you would have 7,000. In year 2, you would have 7,000. In the last year, you're going to have how much? Well, what is 19
2,000
plus 14?
You'd have 2,000 in the last year.
Why?
Because it says that the book value is 16. No, it would be 19,000. Yeah, so you have 5,000. Yeah, sorry.
Exactly. So that gives you 33,000. So how much are you going to depreciate the asset in the last year?
5,000.
2,000.
2,000.
Yes, because 33,000 is the total depreciation written off. All right, so 19,000 was 2 years ago.
Yeah.
The 14,000 is 7,000 for another 2 years, and then that gives you 33. Then there's still 2,000 that's written off in year 3.
Okay.
Can I show that to you? Here's it.
Yeah, please. Yeah, please, if you can.
There's the 772.
Yeah.
Okay, so we spoke about this earlier. This is the existing asset. How much did the old asset cost when you bought it? 35,000.
Oh, no. Okay. Yeah, okay. I understand where the 772 is now. No. I understand that. Okay.
Because the 19,000 is the depreciation that you've already written off. Okay, so there's still 16,000 that needs to be written off, which is 7,000 one year, 7,000 another year, and the remaining 2,000. There's it. 772.
Okay, so for this question though, it says calculate the operating cash flow. So would that just be the normal thing where you would calculate basically your normal thing with if it was a straight depreciation with the 7,000? Because the next one, it says what are the incremental operating cash flows for each year?
Okay, incremental means the difference between the new and the old.
Okay.
Okay, so how much does the new asset generate every year?
The new asset, I'll tell you now. Just hold on. So I just need to go back. So 30,000. Okay, so depreciation is 6,000 over there. That is 17,500. Minus so you'd have 18,176.50 would be your cash flow for the new machine.
Almost, not quite. It's 18,425. Something went wrong.
Okay.
Just check your workings. Did you get sales of 56, fixed cost of 14, and variable cost of 24,500?
Yep, that's exactly it.
Okay, no interest. EBIT is 17.5. Tax is 5,075.
Okay, so just hold it. So
29%.
Okay, so 50. Just hold on 1 second. Okay, so we've got 56 minus 24,500 minus 14,000 equals. Okay, that gives me 17,500. Oh, that's what I did wrong. Okay, 17,500 times 5.71 equals 12,425. So 18,425. So 18,425.
Yes, good.
So I just for some reason I put a 1. I made it 17,150 instead of 17,500.
Okay. It's a silly mistake, but you had the right workings. That's good.
Yeah, okay. And then the other one. Sorry, I'm just working out the other one quickly. Okay, so I've got 10,476 as the cash flow on the old one, and then 80
year?
for the first year.
Okay, no, we need to check that. The first year, you should have had sales of 20,800, fixed costs of 6, variable costs of 10,400.
Yeah, I've got that.
Gives you an EBIT of 44.
Yeah.
Tax that at 29% gives you net profit after tax of 3,124.
Okay, that's probably what I did wrong. Yeah, that's probably what I did wrong was the tax 4400 times by 0.79 equals 3476. Okay, so that's 1276. Yeah, that's what I did wrong because I just got the tax wrong. 4400 equals. Okay, so that's 3124, and that gives you 10124. Okay, so 10124, and then in year 3. So for this first question, would you have to do for the old asset for year 1, 2, and 3?
And 4 and 5.
5. Okay.
Okay, so the reason why you do that is because does the asset still have depreciation in year 4 and 5? No, because the asset has been completely written off.
Okay.
So there won't be depreciation in the last 2 years, looking at the 5 years.
Yeah.
Okay, so we spoke about the 7,000 that's remaining. Remember, the carrying value of the asset is 16,000. You're writing off 7,000 a year, meaning you're going to write off 7 in year 1, 7 in year 2, and you're going to write off the last 2,000 in year 3.
Okay. But then what happens to that cash flow? I mean, what happens to the cash flow for the, I suppose that becomes part of the investment thing, eh?
What do you mean cash flow? Cash flow for what?
For the rest of the depreciation, the 16,000, where do you show that?
The 16,000, this 16,000.
Yeah.
There's the 16,000, 772.
Where's the 772? Okay.
That's the 16,000 that you still need to write off over the period.
Next year. Okay. Oh, okay. Now I get it.
Okay, because the old asset is already old, so there isn't 5 years worth of depreciation.
But I mean, how do they expect you, I mean, in this space, how do they expect you, are you sure, calculate the operating cash flows of both machines? So are you sure you need to do, I mean, because with the space that they've got you, I mean, you can barely fit 3 into this thing.
Yeah, well, you're going to have to maybe ask for more paper to write it out separately or try squeeze it in or fit it in, but yeah, you have to do these calculations.
Okay, cool. And then so how would you calculate the incremental cash flow?
Okay, so that's what we were talking about. So now, if you look at the OCF, you've got the new and you've got the old. Right, so remember, when looking at relevant costs, is the old asset relevant to the decision making?
But why would the asset be over 5 years if there would only be like less than 2 years left on it?
Because you're not looking at the old asset, you're looking at the new asset. You're replacing the old asset with the new asset.
Okay, cool, no problem.
The old asset is going to have a certain amount of time left over, and the new asset is going to be used for how long? 5 years.
Mm-hmm.
Okay, so the decision is, am I going to buy a new asset and replace the old asset? If I do, is the old asset relevant to the new asset?
Yeah.
Yes. So if I replace it, will I forego the OCF here?
Yes.
Yes. Those are opportunity costs.
Yes. Okay. Cool.
All right. So then all we do is that take the one minus the other, get the incremental.
Okay. Cool. Okay.
Does that make sense?
Yeah. 100%.
Okay. All right. So looking at this. This project is going to yield those cash flows, the new less the old.
Yeah. Okay.
Happy with this one?
Yeah, yeah.
Okay, good.
Definitely. Okay, so so the next question, the 1.4, it's a net present value on the net present value rules. So would you add up all the cash flows? Would you add up all the relevant cash flows and get your net present value of that and make the assumption on that, or how would you handle this?
Yeah, with this is decision making. So you would have to base your answer off the NPV that you would calculate. So looking at the incremental cash flow, which we just saw.
Okay. Yeah. So you're
going to have to discount that back in time, taking the initial investment into consideration.
Okay. So
what is your initial investment?
Oh, okay. So you would do. So it would be the initial investment would be. Sorry, I'm just trying to find it. Would be your 11,160.
Good. And what is the OCF going to be for each year?
Would be your new. Would be what you worked out in your incremental stuff.
Exactly.
And your interest rate?
The interest rate will be in the question.
It's 10%, wasn't it, I think?
Yes.
10%. Okay, no, that's a normal cash flow.
Yeah, so let me show it to you, and then you can work it on your calculator to see if you can still do the cash flow. Right, there's it. There's the diagram. Okay, the only problem with this question is the question didn't talk about a terminal cash flow. Right, and that's why I made a note in the answer that I sent to you that there is a question mark next to the TCF. If they did talk about a terminal cash flow, for example, a residual value or anything along those lines, you would have to include it in your cash flow calculation.
Okay.
Okay, but they didn't talk about it, so I'm assuming it's 0.
Yeah. Okay, right. Cool.
And then I just take that, plug it into the calculator, get an answer, and what NPV do you get?
Yeah, I didn't actually work it out. But I understand how to work this out. It's not that...
Can you do it quickly and let's see what decision you get to? Will you accept or reject this project? Would you replace the asset or not?
Just hold on 1 second. Would you have to do both? Would you have to do it for both? Or would you just do it for the one?
What do you mean for both? There's only one calculation.
Yeah, but you wouldn't do the cash flows for the new one, seeing as there is no outflow. Would you do the old operating cash flows versus the new operating cash flows?
No, the new...
Oh, no, never mind.
The new minus the old gives you the cash flow. Okay, so it's only one calculation. You're only looking at that.
Yeah, no, 100%. Sorry, that was not the brightest question I've ever asked. Present value. I get 33,191.
Nice.
At a 10. Yeah, so I would say yes, you would make the decision because it's higher than the 10%.
Yes, well, NPV is positive, so meaning you would definitely replace the old machine with the new one.
Yeah. So if even if NPV was 0, you would say yes, because anything 0 or greater means that you're making your return.
Yeah, you're basically benefiting by replacing the assets.
Okay, cool.
Good.
Okay.
Okay, we did one similar last night. This is actually a very similar question to what we spoke about. So I'm guessing you would find this quite easy to do, right? Question 2.
Financial 10,000 outstanding. Yeah, okay.
Looks pretty similar to the one we did yesterday, hey?
Yeah, it does.
Thoughts? How are we going to calculate the number of shares?
Well, you would look at what the structure is going to be. So, so you've got two capital structures, first of all. Yes. Capital structure A, where it's 40% and 50%. So if it's 40%, you'd need to look at if it's 40%, you need to have the share price at 6, or the equity at 60%.
Okay, just one other question. Are there only two capital structures here?
Well, that says capital A and capital B.
Yes, but what about now, currently?
Sorry,
okay.
What about?
What about now? What about the current situation?
Now it's 100%.
Yes, okay, so you can't ignore the now as well, hey? So always look at the current and then the proposed.
Yeah.
Okay, so you actually have three capital structures. You have one with no debt, and then you have one that has debt, 40%, and one that has 50%. Yeah, so you would actually have to draw up three columns. No debt, 40% debt, 50% debt.
Yeah, okay.
Okay, so just analyze the current as well. The current situation is important because you're going to change it either with option 1 or option 2.
Yeah, okay.
Right, so how many shares do we have?
Okay, so we've got 10,000 outstanding ordinary shares. Okay. I'd this completely the other way around. So what they're going to do is they basically want to buy back the shares and finance it with debt. Yes. So if we're looking at zero, the thing would stay exactly the same. You wouldn't have any sort of impact on it. The other one, if you looked at 40%, you'd still have 60% equity. But what you would have to have is that now your debt portion of it would be, it would be 35 times by 6,000 for the one. That's what your debt would be, because that's what you'd be introducing in order to buy back the shares. But then you would obviously have to look at, obviously what the expected sales, fixed costs are estimated, and variable costs are estimated at 30% of sales. So you'd need to work out what the EBIT is.
Not for the first question. For 2.1, you're doing too much.
Okay. Calculate the number of shares to be purchased under each proposed capital. Well, okay, so for the first one, it's quite easy. I mean, the first one, so if you have 0, you'd have 0 shares purchased back. The second one, you'd have 60% of the shares would need to be, 40% of the shares would need to be purchased back at, so 4,000 shares at 35 Rand each. The next one would be 50% at 35 Rand each.
Good. That's perfect, yeah. So you can split it. So what I've done here is I've drawn up the table similar to what we did yesterday, and I've shown the equity, and then I've shown the debt. So if you introduce debt, you're obviously going to have to buy back the shares.
Yeah.
Good.
Okay, cool. So total finance. Yeah. Okay, cool. 100%. Yeah. Yeah, I must just remember when I look at this stuff, before I start reading the question, I must go and take a look at the
required.
Yeah, I must go and take a look at what the required is.
Correct. Always start with the required.
Yeah. Okay, so earnings per share. This is the one equation I can never remember.
It's profit over the number of
shares. Oh yeah, it's profit minus preference shares.
Yes, preference share dividends, but there isn't one here.
Yeah. No, but I mean, I must just remember that because in some question there might be a preference share and then you don't know. Sorry, I'm just making a note of EPS.
Yeah, it's good to make notes. So write as much
just
as you
making
need
notes
to.
I'm just making notes of all the relevant formulas that I need to know.
Yes.
So that I've got an easy reference point to go and look for them. If I get stuck or something while I'm busy doing the preparation. Okay, so your EPS is your profit minus your preference shares divided by number of outstanding shares. So I mean that's quite easy. You would need to work out so your expected sales of 530. You'd need to do you'd need to do your calculation to work out what your thing is. Then you would need to take off interest for the 40 and the 50% ones.
Yes.
Because on the first one there's 0 to give you what your actual tax is. And then from there you can work out what your earnings per share is. So
Correct.
You divide profit divided by the number of outstanding shares, which would be 6,000. Well, would be 10,000, 6,000, 5,000.
Yes.
Okay, cool. I'm quite happy with that.
Okay, so maybe just to.
I just didn't actually. You know what my biggest problem is, and that's what I'm getting to understand now, is that I need to actually look at what the question asks.
Yes.
So the weighted average cost of capital for each proposed structure would be what we did earlier with the capital where it was one of the questions. It was one of the multiple choice questions.
So you have to split it between the different forms of capital.
Yeah. So what I would do is on the first one, obviously you've only got one form of capital, so your weighted thing would be quite easy to work out because you've only got equity.
Exactly. No debts.
And so on the other ones, you'd just have 0. Well, you'd only work out on 2 because you've got no preference shares. So the WACC would only be times the cost of debt minus the tax and the equity, and you do that for each 3. So you do that for the 0%, the 40%, and the 50% thing.
Correct.
And I mean it's pretty much the same one. Okay, cool. Okay, based on the firm approach, V equals EBRT over the capital structure would advise to objective is to maximize its value. Okay, so the value, we discussed this not long ago.
Yes, what are you going to say here for this one?
Well, I mean, you've worked out your weighted average cost of capital, so the value of the firm would be, it's quite easy. You just put in everything you've worked there. So you would need to, so for each so you'd work out what the value structure for each capital structure would be using the formula that they've actually given you there. And then whichever one's got the highest value maximizes the value is the one which you would choose. So you would work each of them out based on that formula, and then because you've got all the stuff, you've already worked all the stuff out. So it's just basically putting it into the formulas, calculating it, and then you'd work out which one that gives you the highest value. And okay.
Yeah, the problem with this question is that you would have seen, if you did do the workings, the costs, the WACCs were the same.
Yeah.
It's actually very similar to that other question.
The WACCs were exactly the same on the other question though as well.
Yeah, remember, UNISA tends to copy-paste questions and then they just change one or two things. The only thing they changed here in this question was this. Where was it? The sales. That's all they changed.
Yeah.
Okay, it was exactly the same. The only thing that UNISA changed was they made this, I think, 6:30 last night. Tonight it's 5:30.
Okay. Yeah, okay. So then, I mean, if the WACC's the same, it's all going to come out pretty much as the same.
Yeah, it's just it's a lazy way of testing because they've just copied a question and changed one thing.
Yes, they are absolutely useless, actually, eh?
Well, it depends. I mean, for someone that has done that past paper, you would have seen it, I've already done this, and then just redo what you just did.
Yeah, but I mean, it doesn't really...
It's problematic, I agree.
Yeah, I mean, it's not really testing you. It's not really testing the knowledge because I mean, so like your answer there would be like you put that actually remaining exactly as they are is possibly the best structure to be because there's no risk, because there's less risk because there's more risk when you use more debt, effectively.
Well, you can discuss the risk side of things, but what you could also talk about is the shareholders, because have a look at this. If I go back, Do shareholders want the first option, the second option, or the third option?
They want the first option.
They would want the third option. Because the third option gives them the highest earnings per share and the most dividends.
Okay.
All right, so that's something that you could discuss in your answer as well.
Okay.
Okay, but that's just something additional looking at this side of things.
So only 2 marks. So, geez, they ask you fucking a lot. You got to do a lot of working out for like very few marks here. Eh?
Well, remember, the last answer just had this as a calculation, and then I would just summarize. So if you wanted to add more to the answer here, you could talk about the EPS.
Yeah, I mean, so it's based on the value of the firm approach. But if the value of the firm approach is all of them exactly the same, which capital structure would you advise if its objective is to maximize value? I would say any of them. I mean, I wouldn't even speak about the risk. I wouldn't even speak about shareholder value because it's just asking about maximizing the value of the firm.
Yeah, well, that's fine. If you want to keep your answer shorter, then that's not a problem. But just remember that in a UNISA exam, remember it's a written section, it's a written paper. So I would use as much time as you possibly have in the exam. So even if the questions are 2 marks, still write more just in case.
Yeah, 100%.
Don't assume that just by saying, well, it doesn't matter what value you're going to choose, it's still going to be the same. Yes, that might get 2 marks. No, it might not. The thing is, it depends on their marking. All right, so that's my only reason for giving more theory. Giving more theory is better because it shows greater understanding. So even though the memo might just have a simple answer, we don't know what the memo has, so rather write more if you can. And that's the only reason why I'm introducing this and this, because those are things that you could talk about if you wanted to, if you had time to.
Okay.